Okay, welcome to the Chapter 19, which is Financial Statements for a Corporation presentation lecture. In this presentation lecture, we are going to go through the first two sections of Chapter 19. First section being the ownership of a corporation, and then the second section being the income statement. So we will touch upon the ownership in this section here and income statement here, and then we will do section 3, which will be in the next presentation lecture. So 1 and 2 in this one. So please make sure that you have your notes and demo problems available so that you can attempt the demo problems and also take down the notes as we go through section 1 and section 2. Okay, so let's get started. When it comes to the ownership of a corporation, what we are used to is owner's equity. That means that there is an owner who acquires equity within the organization itself. Now, when we get to the situation of a corporation, now we have more than one owner. We have stockholders who own equity within the corporation. So we have two different equity accounts that we are going to utilize when determining the equity within our corporation. One being capital stock. This is the stockholders' equity account. And then there's also stockholders' equity, which is the value of the stockholders' claims to that particular corporation. So these two are going to work together in an attempt to show the equity within a corporation. So as we go through this, you'll kind of see how this all comes together. But if we take a look at 6 and 7 here down here, these examples, the T account example is that if we were to start a corporation, we might sell $25,000 in stock. And if we do that, we are going to increase our capital stock account by crediting it $25,000 and then debiting cash in bank because it's cash on hand that we have that we can use for our everyday operations. This is what it would look like in the T accounts, and this is what it would look like if it was journalized in the general journal. Debit to cash and bank, credit to capital stock. Of course, then obviously you have your source document. All right, so reporting equity in a corporation, stockholders' equity is in parts. Let's take number 1. Money stockholder has invested. And then also number 2, which is the amount accumulated through net income earned and retained by the corporation. So that's an account called retained earnings. Retained earnings is an increase in stockholders' equity from net income not distributed to the stockholders. This is going to get kicked back into the organization in an attempt to pay for expansion, possibly other operating expenses, and so on. These earnings are not going to get kicked back to the owners. They are going to stay within the operation itself, the operation of the organization. Retained earnings is an owner's equity account, which means it's going to have a normal credit side balance, which means credit is going to increase and debit is going to decrease. Now, balance sheet. These accounts are going to be represented in the balance sheet. In a sole proprietorship, we had equity accounts, we had owner's equity, we had the owner's capital account. That was it. In a corporation, we have stockholder equity, and then we have two accounts that are going to indicate the overall equity in a corporation. That's going to be shown within the account of capital stock and also retained earnings. So slightly different, same concept. It's still equity that's accumulated, but the question is who has the rights to that equity? In a sole proprietorship, it was the owner. In a corporation, it is the stockholders. So when it comes to financial information, who uses the financial statements? It is the same as it was in a sole proprietorship where the owners, I'm sorry, not quite the same. Let me rephrase that. In a sole proprietorship, the owner is going to take a look at the information and distinguish the data that is being represented in those financial statements in order to make decisions. In a corporation, it might be the CEO, the COO, the CFO, all of our different chief operations officers, could be chief operations, could be chief financial, could be chief executive officers, are going to be looking at this data and then making decisions based off of those financial data, which is going to be represented in our financial statements. So those individuals are going to be looking at that. Also, potential investors, additional potential stockholders who may be wanting to invest in our corporation may also be looking at that data to see if the investment is worth their money. Therefore, they can determine whether or not they do want to invest or they do not want to invest. All right, so why are financial documents even used? Well, 3 reasons: comparability, reliability, relevance. Comparability allows accounting information to be compared from one fiscal period to another in order to make those data-driven decisions. It can also determine financial patterns and relationships. So as we take a look at the history of the financial data, we can determine whether or not we have a thriving or expanding corporation or a declining corporation. There's also a reliability factor. This is confidence that users have information that is reasonably free and biased from error. And then also relevance. So the two R's, reliability and relevance. Relevance being information which makes a difference to a user in reaching a business's financial decision. So all of these are going to be factors as to why financial documents are used and why they are analyzed and why they are very important when making different business decisions. Another reason for financial documents is full disclosure. Now, when it comes to full disclosure, we're talking about financial reports that include enough information so that the report is complete. So all those documents have to, like when you receive, like in chapter 18, when you were working on completing the 10-column worksheet, you were given a partial worksheet. That would not be considered a full disclosure financial report because it was not complete. Once you went through and did the calculations and analyzed the adjustments and then determined net income or net loss, and then also finally applying the matching principle, now we have a completed document, now we have full disclosure. There's also materiality. Information deemed relative, which should be included in financial reports. Typo right there, we're going to have to get that fixed. But these are deemed as relative because they are going to be included in the financial reports, which means it is data that we want to communicate to our chief officers as well as potential investors. Now, within section 1, if we look at this, we are going to refer back to the accounting equation. So use the diagram like this one to describe the basic accounting equation for a corporation. What it would be, we know assets equals liabilities plus owner's equity in a sole proprietorship. However, now, same concept, different acronym. Now it's assets equals liabilities plus SE, or stockholders' equity, and the account, capital stock, and retained earnings are the two accounts that are going to analyze the stockholder equity. All right, problem 19.1, analyzing stockholders' equity. We will be working through that in class and or as an independent practice problem, as well as analyzing storage documents. Actually, both of these will be independent practice problems, which you will be going over and you will be working on your own after we have completed the demo problems. Let's take a look forward here at the income statement, which is one of the first financial statements that you'll be constructing here in chapter 19. The income statement. The service business is titled Roadrunner Delivery Service. We have revenue, we have expenses, and we analyze those two in order to determine do we have a net income or net loss. Now, in a merchandising business, we're going to use On Your Mark athletic wear, and this one is going to include a lot more to determine whether or not we have a net income or net loss. In this one, we're going to have our revenues, as we did over here in the service business. Cost of merchandise sold. Now we are a merchandising corporation. Gross profit on sales after subtracting cost of merchandise sold, then minus the operating expenses to determine net income or net loss. So the income statement is going to be quite a bit more detailed in a merchandising corporation than it would be in a sole proprietorship. Here is an example. This is also in your textbook to take a look. Now, when we go through demo problems and start constructing this income statement, you will see that numbers go in different columns. And as we go through the demo problems, we will be discussing why these numbers go in certain columns and what this means when actually being able to decipher the data, or what exactly is this income statement showing. Now we break it up into parts. Let's first take a look at the revenue section. In the revenue section, we title it revenue. We then include all of our revenue accounts and contra accounts. So in this case, sales, $320,450, minus, because we have to deduct, discounts and sales returns and allowances. That is then going to add up to be $22,730. Subtract that from our sales, which means that our net sales is $317,720. So all of these numbers, depending upon which column they go into, is going to be able to help the reader or the viewer decipher these different calculations and how these calculations are indeed the math that goes along with it to determine whether or not we have a net sales, what that number is, and how it is calculated. Demo problem 19.1, go ahead and give that one a try if you like. Otherwise, when we come to class next time we meet, we will be going over this and constructing the revenue portion of the income statement. Now, after the income statement, then we have to take into consideration our cost of merchandise sold. This is our analyzation of our inventory. So cost of merchandise sold section, which is labeled, we take our beginning merchandise inventory, then we are going to add into it the additional inventory purchases, plus the freight that we had to pay. That's also part of cost of merchandise. So then we have cost of delivered merchandise here. Then we are going to subtract out of that the discounts and the returns and allowances that we had allocated from our vendors. That equals 3,140, giving us our net purchases here of 207,596.18. Cost of merchandise available, this is the cost of the inventory that we have on hand. And then we also have the inventory that we had at the end of the year. So what is the cost of merchandise that has been sold over the course of this accounting period? That number is right here. If we take that number and subtract it from our sales, we know that we have our gross profit. If we have more revenues in sales than we have inventory costs. So net purchases is cost related to merchandise purchased during that period. Gross profit on sales, profit made during the period before operating expenses are deducted. We'll be going over this section, this part of the income statement in a demo problem 19.2, which we'll be doing in the next time we meet in class. Otherwise, if you have it, please go ahead and give it a shot. We'll be looking at that, as well as 19.3. So these demo problems we'll be going over. These are part of section 19.1 and 19.2. Like I said, give them a try if you wish. Otherwise, we will be going over them together. The next part of the income statement is the operating expenses section. So here we are going to list all of our operating expenses, and they are labeled. So here they are, all listed here, amounts here, equaling the total operating expenses. Operating expenses is the cost of goods and services used in the process of earning revenue for the business. Selling expenses are incurred to sell or market the merchandise that is sold. And then finally, another category of expenses, administrative expenses, which are the costs related to the management of the business. All of these are going to be included as expenses and will be accounted for in the income statement. Then finally, at the end, we determine whether or not we have a net income or a net loss. If we do the math, we'll find our operating income. Then we have to subtract out our corporate income tax expense, which we adjusted when we did the worksheet in Chapter 18, thus giving us our net income of $32,674.72. Now, the operating income is the amount of income earned before federal corporate income taxes are deducted, because the corporate income taxes are deducted based off of that income. So after we pay our taxes, that is what we are left with. All right, so completing the income statement, demo problem 19.4 will take us all the way through and complete the income statement. We'll be doing this together in class. But if you want to give it a try on your own, feel free to go ahead and do so. Now, analyzing the amounts on the income statement, it is easier to analyze if you change dollar amounts to percentages. So we also have what's called vertical analysis, which is each dollar amount is shown as a percentage of a base amount, and the base amount on the income statement is always based off of net sales. So what might that look like? So an income statement might look like this. And notice over here in the percentages, we have the current year, and then we have the previous year. So all of these numbers can be compared to the previous year's numbers based off of looking at a percentage. Can be much easier than actually looking at the totals and trying to decipher them yourself. So the percentages make it easier for the reader. That is the purpose of putting the percentages in there, to compare one year to the next. So on section 2 assessment, if you do the math, look at the comparative income statement provided here and answer the following questions using the vertical analysis of this financial statement. So based off of this, answer these questions. If you are able to answer these questions based off of the income statement given here, chances are you have an understanding of how to analyze and decipher what is being represented in terms of information in the income statement. Okay, and then also problem 19.3, which will be a independent practice problem, which you'll be working on your own, which we'll be going through and giving you practice on this as well. That concludes the section 1 and section 2, chapter 19 presentation lecture. Please make sure you go back and check to make sure you have all of the notes or attempt the demo problems. And I will see you next time we meet in class, and I will see you here for the chapter 19, section 3 presentation lecture.